Everyone, and welcome once again to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it has been a relatively quiet day so far in the markets, despite the fact that the US has rejoined after the long bank holiday weekend. In terms of news flow, economic data, it has been a little bit quieter. There was plenty of news flow yesterday, which helped make up for the lack of activity from the US front. But today we've really lacked on that side as well. The markets themselves, we're seeing European markets trading slightly lower. US markets are a little bit mixed at this stage. We are seeing some activity in oil once again. Really, the Brent crude, WTI now both just unwinding those positions from yesterday. So the big rise which we saw on the back of the press conference from Russia and Saudi Arabia has now been almost entirely undone, which says, I guess, a lot about what people thought of this new cooperation that they've announced, which it seems to be a lot of talk and no action once again, especially considering that Saudi Arabia said there's no need for any oil price freeze, so any hope of that later on this month seems very unlikely, and I think that's why we're seeing these positions now being unwound. We are seeing the dollar come under renewed pressure once again. I think Friday's jobs report really did suggest to people that September is now off the table. I mentioned previously that we really needed a very strong report, the third on the bounce, to properly put September on the table. The market was never convinced prior to the report. Only a very weak report completely takes it off the table, and we got something in between. We got unemployment being unchanged, jobs creation at 151,000, somewhere in the middle of where we wanted it to be. Slightly weaker than expectations, which kind of leaves it on the table. In fact, the market's priced in a 30% chance, which was slightly higher. So clearly the market at the time thought it was just about good enough. But I think today's ISM non-manufacturing PMI from the US really has driven a dagger into that. The report itself, the number fell from 55.5. We were expecting at 55, and it fell to 51.4. Big hammer blow to this number, especially when you consider that the ISM does tend to have more of an impact than the official market PMI, and the fact that the drop was so considerable. At least the official PMI, which was actually released a little early over the weekend, and I think was at around 51. At least this was roughly in line with expectations and what it has been in previous months. This is a big drop here, and the biggest drops that we saw in the number came from the new orders, which fell from 60 component, which fell from 60.3 to 51.4, and the business activity, which fell from 59.3 to 51.8. Employment didn't fare too much better. This fell from 51.4 to 50.7, so obviously not as big a drop. But again, the message is very consistent actually with what the official PMI reading was telling us, that people's outlook for the services sector really isn't that great. We're seeing lower rates of growth in employment, in activity. The official PMI over the weekend actually pointed at two things. One was the risks to the economy and the presidential election potentially standing in the way. But the fact that this represents the services sector, which makes up around 4/5 of the US economy, is the biggest concern here. We've seen 2 quarters of growth at the start of the year, which have been weak in the US, and this suggests that's not going to improve much in the third quarter, which is a little bit concerning. It does point to very low rates of growth, which begs the question, can the Federal Reserve really consider raising interest rates in these low growth environments? And it's one of the reasons why previously we have seen different Fed officials alluding to the fact that we should maybe see a change of target for the Federal Reserve away from inflation to nominal growth, which takes into consideration economic growth as well as inflation, not just an inflation number. As far as the Fed's concerned, by its mandate, job creation is still very high, unemployment is low, and inflation is moving towards targets. So as far as they're concerned, the economy is ripe for a rate hike, whereas other economic indicators may suggest otherwise. We'll get the latest view from the Federal Reserve later on today. Overnight in the UK, late on in the evening in the US, we'll hear from John Williams, one of the Fed policymakers. I'm sure we'll be very interested to hear what he's got to say, given the data that we've had recently, as well as other Fed policymakers that we hear from over the next week or so. The next meeting is 2 weeks tomorrow, and like I say, the markets have now priced in only a 21% chance for a rate hike, down from 30% yesterday. December still remains just about on the cards as far as the market is concerned, but this is very much open to change if the data continues to perform badly. Aside from that, it's been, like I say, it's been a relatively quiet day. If we take a look at the economic calendar now, I'll just bring this up for you. You can see it has been a quiet day. We had the RBA rate decision and statement overnight. There was unchanged on the interest rates, and the statement itself didn't really allude to too much. They talked about the housing market being a threat, inflation being low, growth being moderate, really the same kind of comments which we've had previously from the RBA. The Australian dollar actually rallied in anticipation of the statement rather than following it, so the fact that the Australian dollar now is up 1.28% on the day is less of a reflection on the statement itself and more built on the expectation that the RBA may not cut interest rates again this year, particularly not over the next month or two. German factory orders were slightly weaker than expected. GDP from the from the Eurozone was unrevised, so there was nothing really too significant to come off the back of that. And like I say, the rest of the economic data today is relatively low level. I think the focus now for the rest of the week is going to be on the central bank events. We've got Mark Carney speaking before the Treasury Select Committee tomorrow, delivering the inflation report. Going to be heavily grilled, you'd imagine, given his warnings leading the lead up to the Brexit vote and the massive stimulus that we saw following it. And given that the economic data has performed relatively well, there's going to be plenty of Brexiteers on the Treasury Select Committee who will have in their eyes, he has a lot of questions to answer. He's meant to, of course, be independent, and they've taken the view that there was nothing independent about his assessment and that he was actually taking a political side, or it was at least taking a side in the pre-Brexit debate, which he, in their belief, wasn't supposed to do. So I think he's in for a grilling tomorrow. I'm sure he'll mention the fact that their efforts is what's helped support the economy since the Brexit vote, and that his the analysis of the Bank of England was based on longer term outlook rather than the first 2 months. But like I say, I'm sure there'll be plenty of grilling going on here, which means plenty of volatility for the pound. We've also got the Bank of Canada decision tomorrow and then the ECB on Thursday, so still plenty to come this week, with a key focus now on the central banks of the UK, Europe and Canada. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.